You just got paid. Direct deposit hit. You pull out your phone, open the banking app, and there it is. That number at the top of the screen. You already know it's going to be less than you want it to be. It always is. But today, you actually do the math. You earn $55,000 a year. Divide that by 12, you should be pulling in about $4,600 a month. That's what you agreed to. That's what your offer letter said. But your bank account just got a deposit for, let's see, $3,000 and change. Maybe $3,200 if it's a good month. So where did the other $1,400 go? You check the pay stub. Federal tax, state tax, Social Security, Medicare, maybe a 401k contribution you forgot you set up. It's a list of line items, and every single one of them is pulling money out of the check you earned. You don't fully understand all of them. You just know the total hurts. So you do what anyone does. You Google it. How much tax do I pay on $55,000? And Google, ever helpful, spits back a bracket table and tells you you're in the 22% bracket. 22%. You sit with that for a second. 22 cents of every dollar you earn goes to federal income tax. 1 out of every $5, roughly. You start doing the mental math. 22% of $55,000 is $12,100. Gone. Just gone. Given to a government that can't seem to fill a pothole or process a passport in under 3 months. Except that calculation is wrong. Completely wrong. And the gap between what you think you're paying and what you're actually paying is so large that it's warping the financial decisions you make every day. Here's what's wild. You're not dumb for believing it. This isn't some obscure tax loophole buried in the IRS code that only accountants know about. This is the most basic, fundamental mechanic of how income tax works in this country. And the way it's communicated on Google, on pay stubs, in casual conversation, practically guarantees you'll get it wrong. The system isn't hiding, it's just badly labeled. And nobody corrects you because nobody corrected them either. That raise you thought about turning down because it would push you into a higher bracket, you left real money on the table. That side hustle you never started because you figured taxes would eat the profit? Wrong. That tax refund you celebrate every April like it's some kind of gift? That's your own money being returned to you after the government borrowed it for a year, interest-free. And here's the kicker, you're not alone. This isn't a you problem. This is an everyone problem. Most Americans cannot correctly explain how their own taxes work. Not because they're lazy, not because they don't care, because the system was never designed to be understood by the people paying into it. Tax literacy isn't taught in high school. Your employer doesn't explain your pay stub. The IRS website reads like it was written by a lawyer who hates you. So you piece it together from Google, from co-workers, from social media, and the picture you build is almost always wrong. Your paycheck isn't lying about how much was taken out. The number on your deposit is accurate. But everything you believe about why that number is what it is, the whole framework in your head for how taxes actually work, that's where the lie lives. And it's been costing you this entire time. Here's the version of taxes that lives inside most people's heads. You earn a salary, you land in a tax bracket, and the government takes that percentage of everything you make. Clean, simple, brutal. If only it worked that way. It doesn't. It has never worked that way. Not since the modern income tax was established over a century ago. But this myth, the flat bracket myth, is so deeply embedded in the way Americans talk about taxes that even people who should know better repeat it constantly. Your coworker says it. Your uncle says it at Thanksgiving. Financial content on social media reinforces it every single day. And it's wrong every single time. The US federal income tax system is what's called progressive. Not progressive like a political ideology, progressive like a staircase. Each step has a different rate, and you only pay that rate on the income that falls within that specific step. The steps below it, already taxed at their lower rates. Locked in. Done. Let's make this real. You're a single filer. You earned $55,000 in 2024. Here's exactly, dollar by dollar, how the IRS calculates what you owe. Step 1. The first roughly 11.6K you earned, Think of it as the money from January through roughly the first week of March is taxed at 10%. Just that chunk. Not your whole income, not anything above it, just that first 11.6 thousand. 10% of that is around 1,200. Step 2. The next 35,500 or so, covering everything from just past 11.6k up to about 47k, is taxed at 12%. Not 22%, 12. The staircase moved up one step, but only the dollars on that step feel the new rate. 12% of that chunk is roughly 4,300. Step 3. Now you're past that 47,000 mark. You have about 7,800 of income remaining to get to your 55,000 total. This, and only this, is the portion that sits in the 22% bracket, the part the internet warned you about. 22% of that is roughly 1,750. That's it. 3 steps, 3 different rates, 3 different chunks. Add them up. Around 1,200 plus roughly 4,300 plus about 1,750. Your total federal income tax, 7,153. Not 12,100, which is what you'd owe if the 22% applied to everything. Not even close. The actual number is 7,153, almost $5,000 less than the flat bracket myth would have you believe. $5,000. That's a vacation. That's 3 months of car payments. That's the difference between thinking the government is crushing you and realizing it's taking a piece, sure, but a much smaller piece than you feared. And this gap only widens as income grows. Someone earning $100,000 is in the 24% bracket, but their effective federal rate is about 17%. Someone at $200,000 is in the 32% bracket, but their effective rate is closer to 23%. The gap between the marginal number and the effective number is always significant, and it's always in your favor. Now let's talk about what that means as a percentage. 7,153 divided by 55,000 is 13%. That's your effective tax rate, the percentage of your total income that actually went to federal income tax. Not 22%, 13. Almost half of what you thought. The marginal rate, 22%, only tells you what happens to the next dollar you earn past where you are now. It says nothing about all the dollars below it, but when people hear 22% bracket, they apply that rate to everything. And the result is a number that's dramatically, unnecessarily scary. We covered in the last episode how your 401k match is literally free money most people ignore. This is the same category of problem. The information is right there. The math is not complicated. But the default understanding that most people carry around in their heads is so deeply wrong that it leads to genuinely bad financial choices. You can't make good decisions with bad numbers. And right now, most people are running their financial lives on a number that's off by thousands. This is the section where the misunderstanding stops being theoretical and starts costing people money they can feel. You're making $47,000 a year. Comfortable enough. Not great, not terrible. You're right at the top of the 12% bracket. And one day, your manager pulls you into a meeting, says you've been doing solid work, and offers you a bump to $52,000, $5,000 more dollars a year, and something weird happens. Instead of feeling excited, you feel anxious, suspicious even, because somewhere, maybe a coworker told you, maybe you saw it on TikTok, maybe your dad mentioned it at dinner and it just lodged in your brain. You absorb this idea that earning more money can push you into a higher tax bracket and actually make you take home less. So you start running numbers in your head. You're at 12% now. If you go to 52,000, you'll be in the 22% bracket. 22% of 52,000 is roughly 11,400. You're currently paying 12% of 47,000, which is about 5,600. So you'd pay almost $6,000 more in taxes on only $5,000 more in income? Wait, that can't be right. But also, what if it is? Surveys have shown that a significant chunk of Americans, we're talking anywhere from a quarter to nearly half in some polls, genuinely believe that earning more money could result in a lower paycheck because of tax brackets. That's not a fringe belief. That's a mainstream misunderstanding that is actively holding millions of people back from making more money. Let's destroy this with math, going from 47,000 to 52,000. The first roughly 47,000 of your income is taxed exactly the same way it was before you got the raise. 10% on the first step, 12% on the second step. Nothing changes for those dollars. They don't move, they don't get reclassified. The government doesn't look at your new salary and retroactively punish your old income. That's not how it works. The only new tax is on the roughly 4,800 that crosses the boundary into the 22% bracket, from just past 47,000 up to 52,000. 22% of that is about 1,050. Add the last 150 or so that topped off the 12% bracket at roughly 18, and your total extra tax on a 5,000 raise comes to roughly 1,100. Your extra take-home, nearly 3,900. You are unambiguously, mathematically, no asterisks required, richer. By nearly $4,000 a year. There is no tax trap. There is no bracket cliff. There is no scenario anywhere in the federal income tax system where one more dollar of gross income produces less net income. The staircase only moves in one direction. New dollars get taxed at their rate. Old dollars stay on their step. Period. So why does the myth survive? Couple of reasons. First, withholding, the amount taken out of each paycheck, can shift in weird ways when your salary changes. Payroll systems recalculate your projected annual tax, and sometimes the per-check adjustment creates a temporary dip that looks like a penalty. It's not. It sorts itself out by tax time, but it can feel like proof that earning more costs you. Second, nobody explains this in school. Nobody explains it at work. You hear 22% bracket, and the most natural reading of those words is 22% of everything. That's a language problem, not an intelligence problem. The phrase is genuinely misleading, and the people who use it rarely clarify what it actually means. But the cost of misunderstanding is real and measurable. Every time someone declines overtime, turns down a raise, or avoids taking on freelance work because they don't want to jump a bracket, they're making themselves poorer for no reason, based on a ghost story. A math error dressed up as street wisdom. Let's make this even more concrete with overtime, because this is where the myth does the most daily damage. You make $25 an hour. Your base pay puts you in the 12% bracket. You get offered 10 hours of overtime at time and a half, roughly $37.50 an hour. That's about $375 in extra gross pay. Even if every dollar of that overtime falls in the 22% bracket, the worst case, your tax on it is roughly $83. You take home about $292, nearly $300 for 10 hours of work. Nobody in their right mind would turn that down, but people do. All the time, because taxes would eat it. Taxes eat about 22 cents of each overtime dollar in this scenario. You keep 78 cents. That's the real math. And every time someone turns down overtime, a freelance gig, or a raise because of the bracket myth, they're doing the equivalent of refusing $292 because they'd have to pay $83 for it. It makes no sense once you see the numbers. So the next time someone at work says, "Nah, I'm not picking up that extra shift," taxes would eat it. You'll know exactly what's happening. They're not saving money, they're losing it, and they don't even know. Federal income tax is the line item everyone fixates on. It's the big one, the scary one. But it's not alone on your pay stub, not by a long shot. Your paycheck is getting hit from multiple angles at once. And if you asked most people to name every deduction on their stub, they'd get through maybe 2 before they start guessing. Let's do the full autopsy. You earn $55,000 a year, paid bi-weekly. That's 26 paychecks. Gross pay per check, about $2,115. That's the number at the top of your pay stub, the amount you earned before anything touches it. Here's what touches it. Line 1, federal income tax withholding. Your employer doesn't wait until April to collect taxes. They estimate what you'll owe for the entire year, divide it up, and take a piece out of every paycheck. For a single filer at $55,000 with a standard W-4, that's roughly $230 per check. Over the year, that adds up to about $5,980 in withholding, which you'll notice is actually less than the $7,153 you truly owe. That gap is why some people end up owing money in April instead of getting a refund. But for now, $230 per check. Line 2, Social Security Tax. The official name is OASDI, or Old Age, Survivors and Disability Insurance. This is a flat 6.2% on every dollar you earn, up to a cap of around $168,600. No brackets, no staircase, no progressive layering. Just a straight 6.2% off the top. At $55,000, you're well below the cap, so you pay 6.2% on everything. That's about $131 per check, or roughly $3,400 for the year. Your employer also pays 6.2% on your behalf, by the way. So the total going to Social Security on your income is actually 12.4%. You just never see the employer half. Line 3, Medicare tax. Another flat rate, 1.45% on all earned income, with no ceiling at all. At $55,000, that's about $31 per paycheck, roughly $800 for the year. There's an additional 0.9% Medicare surtax once you pass $200,000 in income. But at $55,000, that's a problem for future you. Federal level deductions total about $392 per check, around $10,200 per year. That's before your state gets involved. State income tax. 9 states have no state income tax: Texas, Florida, Nevada, Washington, Wyoming, South Dakota, Alaska, Tennessee, and New Hampshire. If you're in one of those, your paycheck takes fewer hits and this section is shorter for you. But if you're in California, you're looking at another progressive state tax system stacked right on top of the federal one. On $55,000, that's roughly another $2,000 a year, or about $77 per biweekly check. New York could be $2,500 or more. And if you live in New York City, there's a city income tax layered on top of that. Oregon, Minnesota, New Jersey all have their own rates, their own brackets, their own line items on your stub. This is one of those things that makes comparing salaries between cities almost meaningless without context. $55,000 in Austin and $55,000 in San Francisco are wildly different paychecks, not just because of cost of living, but because Texas takes 0 state income tax, and California takes a couple $1,000s off the top before you ever see it. If you're considering a move or a remote job in another state, this one line on your pay stub can swing by thousands of dollars a year. It's not the first thing people think about, but it probably should be. And we might still not be done. Some cities and counties charge local income taxes, places like Philadelphia, Detroit, Columbus. Some states withhold for disability insurance. If you're in a union, there might be dues. If you opted into employer benefits, there are premium contributions for health, dental, vision. Every one of these is its own line, its own small cut, and together, they're the reason your $2,115 gross check turns into $1,500 or $1,600 in your bank account. So that's the full anatomy of a pay stub. Every line item, every deduction, every hand reaching into your paycheck. But here's what nobody tells you on your first day at work. A lot of those numbers aren't fixed. There are tools, legal, boring, incredibly effective tools, hiding right inside your employer's benefits portal that can move money from the taxable column to the yours column before the government ever touches it. That's next. Your pay stub has all those line items pulling money out before it reaches you. Most people look at that list and treat it like a law of nature, the cost of having a job, the price of participation. But a surprising number of those deductions are adjustable, not through some complicated scheme, not through anything your accountant would raise an eyebrow at, but through pre-tax tools that your employer almost certainly already offers. The core concept is straightforward. Certain types of contributions and deductions come out of your paycheck before your taxable income is calculated. That means the IRS calculates what you owe on a smaller number. Every dollar you move into this pre-tax category is a dollar the federal government, and usually your state government, can't touch. Let's start with the obvious one, the 401k. We've covered why you need to hit your employer match, but even beyond the match, every dollar you put into a traditional 401k reduces your taxable income dollar for dollar. You earn $55,000. You contribute $5,000 to your 401k. Your W-2 still says $55,000 for Social Security purposes, but for income tax purposes, you're only on the hook for $50,000. What does that mean in actual dollars? At $55,000 taxable income, your federal income tax is $7,153. At $50,000, it drops to about $6,050. You saved roughly $1,100 in federal taxes. Your 401k contribution was $5,000, but your take-home only went down by about $3,900. That other $1,100, it was money the government would have taken. Instead, it's in your retirement account. You redirected money from the IRS to yourself, legally, boringly, effectively, and the savings scale. If you're in the 22% bracket, the part of your income above roughly $47,000, every dollar you contribute to your 401k saves you 22 cents in federal tax on top of whatever your state rate is. If you're in California, that's another 6 to 9 cents depending on your state bracket. A dollar in, a third of it was never going to be yours anyway. The 401k just intercepted it. Health insurance premiums through your employer almost always come out pre-tax under what's called a Section 125 plan. If you're paying $200 a month for your employer-sponsored health coverage, that's $2,400 a year that reduces your taxable income. You were going to buy health insurance regardless. This just means doing it through your employer saves you a couple $100 in taxes. It's not exciting, it's just free money hiding in plain sight. Now for the one that doesn't get enough attention, the health savings account. If you're enrolled in a high-deductible health plan, which is common for younger workers since those plans have lower monthly premiums, you can contribute up to about $4,150 a year as a single filer into an HSA. This account has a tax advantage that no other financial tool in the entire tax code can match. The money goes in pre-tax, deducted from your income before the IRS calculates what you owe. It grows tax-free. You can invest it in index funds, just like a retirement account, and the gains are never taxed. And if you spend it on qualified medical expenses, doctor visits, prescriptions, dental, vision, even certain over-the-counter products, it comes out tax-free too. Pre-tax in, tax-free growth, tax-free out, triple tax advantage. A 401k is taxed when you withdraw. A Roth IRA is funded with after-tax money. The HSA, if used correctly, is never taxed at any stage. Some financial planners straight up call it the most powerful tax shelter in America, and most 25-year-olds have never heard of it. And unlike its cousin, the flexible spending account, which runs on a use it or lose it basis, HSA funds roll over every year. You can let them accumulate for decades. Some people max out their HSA, pay medical bills out of pocket, and let the account grow untouched like a stealth retirement fund. FSAs are simpler. You designate pre-tax dollars for medical or dependent care expenses, but spend them within the plan year or lose them. Transit benefits, commuter benefits, these can also come out pre-tax depending on your employer. The details vary, but the principle is universal. Every dollar you shift from the taxable column to the pre-tax column lowers your bill without lowering your actual financial position. The money still belongs to you. It just takes a smarter path. The point isn't to obsess over every deduction or try to game the system. The point is that your paycheck is not a fixed output of a fixed machine. There are settings, knobs, adjustments you can make during open enrollment or any qualifying life event. And most people never touch them, not because they wouldn't benefit, but because nobody handed them the manual. Tax season, April. You file your return, hold your breath, and a few weeks later, a deposit from the US Treasury hits your account, $2,800. and it feels incredible. It feels like the government cut you a check just for being alive. People plan their entire spring around tax refund season, new TV, vacation fund, paying off that one credit card that's been haunting them since November. Tax refund day is basically a second Christmas for some households. But here's what a tax refund actually is, stripped of all the good feelings. It's the government returning money that was yours the entire time. They took too much out of each paycheck. At the end of the year, they counted it up, compared it to what you actually owed, and sent back the difference. That's it. It's not a reward for filing your taxes. It's not a bonus for being a good citizen. It is a refund, in the dictionary definition of the word. You overpaid, they gave it back. End of transaction. If your $2,800 refund was spread across 26 pay periods, that means approximately $108 was overwithheld from every bi-weekly paycheck. $108, 26 times for 12 months. That's $108 that could have been in your pocket every 2 weeks. You could have put it in a high-yield savings account earning 4 to 5% APY. You could have thrown it at a credit card charging you 24% interest, and over a year, that $108 per paycheck going toward a balance like that could have saved you serious money in interest charges. You could have invested it. You could have just used it to eat better. Instead, you gave the government an interest-free loan for a year, and then they returned the principal. No interest, no growth. No acknowledgement that they used your money for 12 months and you got nothing for it. Now, the counter-argument. I'd rather get a big refund than owe money in April. People say this all the time, and they're not entirely wrong. Owing money in April is stressful. If you don't have the cash on hand, it can trigger penalties and payment plans and all sorts of headaches. So there's a version of this where overwithholding is deliberate. It's a safety margin. And there's another version, the more honest version, where people know themselves well enough to admit that $108 per paycheck wouldn't actually get saved. It would get spent. DoorDash, random Amazon purchases, drinks on a Friday. The money would evaporate, and then there's no refund in April either. In that scenario, letting the government hold on to it is, awkwardly, the better outcome. Forced savings through a mechanism you can't easily undo. Fine, that's legitimate. But it's the expensive version of discipline, because there's a better approach that costs you nothing. Adjust your W-4 so your withholding is accurate, then automate a transfer of that $108 into a separate account every payday. A savings account, an investment account, your Roth IRA, whatever. The money vanishes from your checking account the same way it would have vanished to the IRS. Same behavioral effect, but now it's working for you. Earning interest, compounding, growing, instead of sitting in a government holding tank doing absolutely nothing for 12 months. What was your biggest tax refund ever? And what'd you actually do with it? Did it go into something useful, or did it evaporate in a week? Drop that in the comments. The answers always tell a story about how people think about unexpected money. Your W-4. The form you filled out on day one at your job while you were still trying to remember your manager's name controls all of this. It tells payroll how much federal tax to withhold per check. Most people filled it out once, guessed on half the fields, and never thought about it again. The IRS has a free withholding estimator on their website. Takes about 10 minutes. If you've been getting big refunds every year, your W-4 is miscalibrated and you're overpaying every single check. Fixing it doesn't change your total annual tax bill by a cent. It just puts the money where it belongs, in your account when you earn it, instead of in theirs until they feel like giving it back. Federal income tax, $7,153. That's your progressive, staircase, bracket by bracket total. Your effective federal rate, about 13%, not 22%. Social Security, $3,410. Flat 6.2% on everything up to the cap. Medicare, $798. Flat 1.45% on everything, no cap. State income tax, varies wildly. 0 in Texas or Florida. Roughly $2,000 in a moderate state. Up to $3,000 or more in California or New York. Let's call it $2,000 for this example. Total annual deductions, approximately $13,361. Call it roughly $13,400. Total take-home, about 41,600 on 55,000 gross. That's approximately 1,600 per bi-weekly paycheck, or about 3,467 per month deposited into your account. Your effective total tax rate, federal income tax plus Social Security plus Medicare plus state, lands around 24%. Not 22% federal alone like you feared. Not 30-something% like your coworker claims. 24% all in. Let that number sit for a second. 24%. That means for every dollar you earn, you keep 76 cents, 3/4. That's not nothing. The government takes a real piece, but it is a far cry from the government takes a third of everything narrative that dominates break room conversations and comment sections. And the composition matters. About 7.5 percentage points of that 24% is Social Security and Medicare. Money that is, at least theoretically, earmarked to come back to you later in the form of retirement benefits and healthcare coverage. You can have whatever opinions you want about the long-term reliability of those programs, and plenty of people your age have strong opinions. But it's categorically different from income tax that disappears into the general fund. It's more like a mandatory government-run savings program you didn't opt into. Whether it's a good deal is a different episode. That it exists and that it's not the same as income tax matters right now. Another thing worth noting, everything we've calculated assumes the standard deduction, which in 2024 is $14,600 for a single filer. That means the IRS doesn't even start counting your taxable income until after that deduction is applied. Your $55,000 salary? The IRS actually sees $40,400 in taxable income. That drops every bracket calculation further. Your real effective federal rate after the standard deduction is closer to 10 to 11%, not even the 13% we calculated on the gross number. We use the gross to keep things simple, but the reality is even more favorable than the picture we painted. If you're using pre-tax tools, contributing to a 401k, running health premiums through your employer, funding an HSA, your take-home drops further, but your tax bill drops too. The money didn't vanish, it moved into accounts with your name on them, growing for your future self. Your take-home pay is lower, but your total financial position is stronger. This is the real picture, and it looks nothing like the version most people carry around in their heads when they stare at a paycheck and feel that gut punch frustration. The system is genuinely complex, often deliberately opaque, and nobody would call it generous. But it is not the flat rate robbery that the 22% bracket myth makes it seem. Understanding this doesn't make taxes fun. Nothing makes taxes fun. But it makes them manageable, it makes them navigable, and it makes every financial decision you face from here, whether to take the raise, how much to put in your 401k, whether to pursue side income, whether to fix your W-4, based on math instead of mythology. The math says, take the raise. The math says the refund is a problem. The math says you have tools you haven't used. The vibes said otherwise. Go with the math. You opened your banking app and the number was smaller than you expected. That hasn't changed. It's probably always going to be smaller than you want it to be. That's just what happens when you earn a paycheck in a country that funds itself through income taxation. But the story you were telling yourself about that number, the one where you're in the 22% bracket and the government is swiping 22 cents of every dollar, that story was wrong. Your effective rate is lower than your marginal rate. Your brackets are layered, not flat. Your pay stub has settings you've never adjusted, and the refund you celebrate every spring was your own money all along, held in a government waiting room for 12 months at zero interest. You don't need to become a tax expert. You don't need to memorize bracket thresholds or file your own returns by hand. You just need to know that the number in your head, the one that's been shaping your decisions about raises, side income, and withholding, was built on a myth. And myths are expensive when they're driving your money choices. The paycheck wasn't lying about the amount, it was lying about the explanation. And now you've got the real one. Stack smart.